The debt multiplier. Why the Japanese playbook won't save the American bond market. Pinpoint brief. Executive thesis. The global financial regime has completed a full rotation. For nearly 2 decades following the global financial crisis, sovereign borrowing costs were artificially suppressed, allowing governments and private asset markets to build historically unprecedented debt loads. That regime has reversed. Section 1. The central problem of 2026 is not simply that bond yields have returned to pre-2008 levels, but that yields have returned toward pre-crisis norms, while debt-to-GDP and price-to-income multiples remain trapped at post-COVID highs. This structural dynamic creates a rigid policy trilemma between fiscal sustainability, purchasing power, and investor returns. While observers frequently point to Japan's decade-long balance sheet expansion as a roadmap for managing high sovereign debt, the United States cannot assume the same market outcomes. The Federal Reserve can technically execute the same central bank operations as the Bank of Japan, but because the United States operates as a net debtor relying on external capital, aggressive yield suppression alters the risk-return calculus for international holders, transferring structural stress directly onto currency purchasing power and leaving both the Treasury and housing markets frozen under unserviceable principal burdens. Section 2. The dual ledgers. Sovereign debt and residential housing. The housing crisis and the sovereign debt crisis are two expressions of the exact same balance sheet mechanics. Both systems expanded by capitalizing on cheap debt. Both are now paralyzed by the math of servicing large principal balances at normalized interest rates. The following graphic is titled The Dual Ledger Parallel. It compares the sovereign ledger with the residential housing ledger. On the sovereign side, post-global financial crisis and COVID debt expansion leads to high baseline yields of between 3.5% and 5%, which leads to debt service consuming fiscal revenues. On the residential housing side, post-global financial crisis asset price multiples of approximately 8 to 1 lead to elevated mortgage rates of approximately 6.5% to 7%, which leads to transaction volume freezing through the lock-in effect. During the 1970s and 1980s, high mortgage rates were absorbed because the income-to-principal multiple hovered between 3 times and 4 times. Today, the national price-to-income multiple sits around 5 times, while major metropolitan markets regularly exceed 8 times. A 7% mortgage rate on a 3.5 times principal load is an adjustable cash flow inconvenience. A 7% mortgage rate on an 8 times principal load is a structural lockout. The result is the lock-in effect. Existing owners who secured 3% rates cannot afford to trade up, freezing residential supply. Similarly, the federal government faces skyrocketing net interest expenses as older, low-coupon treasuries mature and roll over into higher-yielding issuance. The household buyer and the sovereign treasury are trapped in the same room. Section 3. The policy trilemma. For nearly 2 decades, governments protected fiscal sustainability by suppressing investor returns through low interest rates, while purchasing power remained relatively stable. Today, bond markets have reasserted themselves, forcing a structural choice. The following graphic illustrates the policy trilemma. At the top of the triangle is fiscal sustainability, representing sovereign solvency. At the bottom left is purchasing power, representing currency stability. At the bottom right is investor returns, representing real bond yields. Each point is connected to the other two, illustrating the structural tension between all 3 objectives. First, protect fiscal sustainability. Lower yields artificially via central bank intervention to cap government interest costs. Cost, suppresses real investor returns and risks inflating the money supply, eroding currency purchasing power. Second, protect purchasing power. Maintain higher interest rates and tight monetary policy to control inflation. Cost, spikes debt service costs for the sovereign and freezes private credit markets. Third, protect investor returns. Allow market forces to set yields based on risk and inflation expectations. Cost, forces severe fiscal austerity or risks structural insolvency for high-debt sovereigns. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 4. The Japan Fallacy. Same operations, different transmission. When assessing how the United States might handle this trilemma, market commentary often references the Bank of Japan's decades of yield curve control, during which it purchased over 50% of Japanese government bonds to anchor yields near zero. The operational mechanic, buying treasuries with central bank liquidity, can be executed by the Federal Reserve just as easily as by the Bank of Japan. However, identical operations do not produce identical market consequences. The following chart compares the structural drivers of the Bank of Japan framework with the Federal Reserve framework in the United States. The first category is net international position. Japan is the world's largest net creditor nation. The United States is the world's largest net debtor nation. The second category is capital base. Japan has a deep domestic savings pool with a strong home currency bias. The United States has a high reliance on foreign capital to finance twin deficits. The third category is global role. Japan operates a regional funding currency, with its domestic bond market holding isolated capital. The United States operates the primary global reserve currency and the anchor for international trade finance. The fourth category is primary transmission channel. In Japan, yield suppression is absorbed via domestic economic stagnation. In the United States, yield suppression shifts risk premium directly into currency depreciation. If the Federal Reserve engages in aggressive, prolonged yield suppression to protect fiscal sustainability, it operates in a market backed by foreign creditors. Rather than quietly absorbing subinflationary yields, global investors adjust their risk allocations. The stress does not disappear, it escapes through the path of least resistance, currency devaluation, and persistent inflation. Section 5. Unfreezing the system. Sovereign interventions and their costs. To break the freeze in private real estate without forcing a catastrophic price crash, state-led intervention models are occasionally raised, such as public buybacks of illiquid housing inventory, akin to post-World War II credit guarantees through the Federal Housing Administration and GI Bill, or the United Kingdom's 1980s housing transitions. However, executing a broad state buyback today collides with the sovereign ledger. The following graphic is titled State Housing Buyout Model. The process begins with the government issuing new treasuries to fund asset purchases. This increases sovereign bond supply on an over-leveraged ledger. That pushes sovereign yields higher or requires central bank buying. The final result is the transfer of the private debt load onto public purchasing power. Purchasing excess private assets transfers private debt service off the household balance sheet and onto the sovereign balance sheet. If financed through debt, it increases treasury supply, placing upward pressure on yields. If monetized by the central bank, it resolves household illiquidity by diluting currency purchasing power. Section 6. Conclusion. The economic regime covering 2008 to 2026 demonstrated that suppressing the cost of capital can temporarily mask high principal loads. The return of pre-global financial crisis interest rates has stripped away that mask. Because the United States is bound by its status as a net debtor and global reserve issuer, it cannot rely on Japanese-style insulation to escape this pressure. The yield curve cannot be artificially capped without consequences for the currency. Moving forward, policymakers face an inescapable trade-off: allow market-clearing yields to reset asset valuations or absorb the cost through the ongoing degradation of purchasing power.